other steps that come after that, right? And as an extended hand that we have decided to provide to all our participants over here, we came up with LEAP, a 4-part workshop series conducted as part of the Youth Entrepreneurship Summit of 2022. And over here, we are aiming to provide all our participants with the opportunity to learn the processes that come behind bringing an idea to life and all the strategies that come along with it. And of course, for that, we have the best and the brightest from the industry with us. And with that, also, it gives me a great pleasure to introduce myself. I am Deepika Gulati, and I'll be the MC for day 2 of our Launch Your Startup with Entrepreneurship Awareness Program, LEAP. And I welcome one and all to the maiden event over here. And before we proceed, I would actually like to take this opportunity to invite Professor Srividya Raghavan, who's our Associate Professor for Entrepreneurship. So as you mentioned, that is a course that we have started on now. And also our Chairperson for Envision ECell, IIM Bodh Gaya, to just deliver a small welcome address. The floor is yours.
Dear Mr. Kansal, students from IIM Bodh Gaya and other institutions, it is my pleasure to welcome you all on behalf of the entire IIM Bodh Gaya fraternity to the 3rd session of the LEAP workshop. It's an honor for me to extend a warm welcome to our speaker for this session, Mr. Tushar Kansal, who has contributed extensively in the area of entrepreneurship through his organization, Kansaltancy Ventures, and has used this valuable expertise in a variety of industries to deliver the best to the startup environment. On the first day of the workshop, our participants got an opportunity to interact with industry experts and gain insights on the topic, formulating a stellar business plan and growth strategies for startups. We are eagerly looking forward to today's session on the topic, funding your startup. I'm sure it will be an enriching experience for everyone. As we've already seen from the beginning of the program, where we've had a very interesting conversation already. I would just like to add a few words on the initiatives of the ECell at IIM Bodh Gaya. Envision, our student entrepreneurship cell, are the kartas, so to say, for all the activities of the ECell. Youth Entrepreneurship Summit is a flagship program, 3 years in the running, and they've also been organizing expert talks in a series titled the Youpreneur. Besides, they have been actively working on helping the institute formulate an agenda for incubating startups. Even while the institute is shoring up its resources and planning to develop the environment for inculcating entrepreneurial thinking, at least 7 or 8 startups have taken root and are in the making. We hope that with the support of students, staff, and experts such as you, Mr. Kansal, we will be able to see entrepreneurship culture thrive at IIM Bodh Gaya. Welcome you all once again, and my heartfelt thanks for being here.
Thank you. Thank you so much, Professor Srividya, and thank you, Deepika, and thank you all of you at LEAP and IIM Bodh Gaya for inviting me today. So should I start, Deepika?
Sure, sir. I just had like a small introduction planned out for you, if I could just take a few minutes of your time. So just an introduction to the audience. Mr. Tushar Kansal is the founder and CEO of Kansaltancy Ventures, an accomplished professional with an experience spanning from venture capital, as mentioned, to Big Four Consulting, LSE-listed Systema India's unit, to being the CFO of Guggenheim Partners-owned company. Sir is a mentor and a judge at the entrepreneurship cells of IIT Bombay, IIT Delhi, Madras, Kharagpur, IIT ISM Dhanbad, and other such marquee institutions, with expertise in financial, business advisory, and fundraising. Sir has received his executive education from Harvard Business School, his MBA in finance from University of Delhi, and BTech from the Technological Institute of Textile and Sciences, and has been a part of leading industrial and education houses in India, the Birla Group. Also, sir, I would like to take this opportunity to congratulate you. We saw that yesterday Kansaltancy Ventures won the award of Best Startup Supporter at the India First Tech Startups Conclave, and with sir receiving the award directly from Dr. Kiran Bedi. So congratulations, sir.
Thank you. Thank you so much. Thank you so much. Okay. Thank you so much, Deepika. So this subject is very dear to me, entrepreneurship. I don't have a family background in business. So, my father is from IIT Delhi, 71 batch, and I used to study. I'm amongst the first batches in Vidya Mandir. So, when they started out, I saw that, it's such a good business that you teach people for IIT entrance. And that's how I opened IIT Training Academy way back in 2001. And that was when I had just done my MBA from University of Delhi. So, my entrepreneurship experience started early, but I realized that, there was not so much of formal training which I ever received in the area of entrepreneurship. And it is just by talking to families, talking to someone, that you try and learn how to do a business. Because end of the day, coming from science side, coming from engineering side, I was always trained for technology. But now we are in a phase in our country where we saw 41 unicorns being born in 2001, and the funding aspect is so strong that there were 28,000 startups registered under Startup India in January 2021, and by the end of 2021 there were 52,000. So 24,000 startups got added within a matter of 1 year, and we have been ranked as number three startup ecosystem globally, after, of course, the US and China. And there are all sort of speculations that within this year itself, the number of unicorns will go beyond 100. So now let me share my screen with you. I would like to take show you a presentation on what investors want, what are they looking for. So this is a presentation on what investors want. So basically, uh, see, the investors, they are talking to, like, each good investor receives 20 to 30 pitch decks in a day. And the investors' attention span is very short, because there are always calls coming in. There are always people telling him, do this, put in money here. And the teams are small. So in a venture capital fund, there is a general partner, GP, who makes the decision where to invest the money. The limited partners, LPs, don't have a direct role in deciding where to put the money. But definitely, when the deal comes and it matures within the system, then the deal is presented to the limited partners also, before they are being told to put in money, which they had committed to the fund. So the teams are small, and so it if you are approaching an investor from whom you are seeking money, then you have to be very structured. And in the structure, uh, you know uh, there is no formal structure given anywhere. But we have certain things which, based on our experience, we see that most of the investors are looking for. So the first thing is the problem statement. This is very important. If you talk to a mature company, they will say, oh, come on, don't ask us to start with the problem statement. So they prefer saying that, ask us to start with dynamics of the market. So whichever way you put it, end of the day, you are solving a problem in the market. And the better and wider your problem is, the more chances you have of making a company which will be everlasting, which will be innovative, which will pivot to newer business plans, and which will be able to tide the market. So the problem statement is very important. Many years back, I was sitting in the office of Matrix Partners in Mumbai, and I had taken my consumer B2B company there. And while talking to one of the guys there, he pointed out to me that one of the aspects they consider for investing, before investing, is the problem statement. So he said, Tushar, people are, they want to leave a mark in this world. And if you are, nowadays the consumer is spoiled for choice. He wants the best quality in the shortest possible time, cheapest price. And the Indian consumer is the most spoiled consumer in the world. We are very price conscious, quality conscious, service conscious, and we take time in making the buying decision. We do a lot. I mean, we talk a lot, we study a lot, we'll check ratings, we'll talk to people. And so so when it comes to serving the Indian customer, there is a thing which goes on with the foreign investors. If you are able to sell something to the Indian customer, then that PMF, that product market fit, you can take anywhere on the globe and sell the products. So that is the value of PMF created in the Indian market. What is PMF? Product market fit means that your distribution strategy is tied up, your pricing is tied up, you have done your primary and secondary research with the customer, so what kind of products you want to sell at what price points, all these things, and you are also making some revenue. So that is PMF, and most of the investors want to put in money after PMF, because after PMF it becomes very easy for them. You just put in money, it goes into marketing, the product is already there, the channels are already there, the sales rise, the valuation of the company rises. So it becomes as simple as riding a bull market. So problem statement is very important. Second is solution. If your solution incorporates technology, it is better. And because then it is scalable. And nowadays, Steve Jobs did a human service to the world in the form of the smartphone. So with the advent of the smartphone, he killed GPS companies. He killed all the Symbian, Nokia type of devices. He killed the camera companies like Kodak. He killed so many companies. He disrupted the whole market. So smartphone is the preferred vehicle to bring in your solution, maybe in the form of an app or any such solution. You must have heard of a news 3 days back. Glance is a company which got $200 million from Reliance. And what does Glance do? Glance just organizes the way data is presented on your lock screen on the smartphone. That is it. But it gives, it has access to your smartphone lock screen, which means a part of your attention span. And secondly, uh, in the smartphone business, a lot of data of yours, where you are traveling, what do you eat, what do you talk about, all these things, they throw up huge amount of data for the app companies, for the mobile companies, and this data they crunch. They put artificial intelligence and machine learning to crunch this data, to make sense of this data. And Google has mapped each person on this planet, probably 5 out of 6 billion people, on 700 parameters. So why do you spend between 6 to 14 hours a day on your smartphone? Because it shows you exactly what you want, because it knows. And just God forbid that Jeff Bezos came on record 5 6 days back to clarify that Alexa does not listen to you, because people were postulating that maybe Alexa is in your room, and anytime you say Alexa, it is there. So it is listening, right? And if it is listening and if it is making sense of what you are talking about the entire day, then things are beyond
Hello. Sir, I guess your network is not good right now. The video is
Swapnil, if
frozen.
you can just call
Wait
sir.
a minute, I'm talking.
Just call him.
There's some issue. He's checking. He just give him 2 minutes.
Fair enough.
Akash, meanwhile, you can just keep the banner on and
Music.
if we wait for sir.
Guys, the music also. Yeah, so before he comes, I'd like to tell that when he came, he shared a couple of links. His corporate link. I'll be sharing all of those again in case you want to connect with him or know what he does. His LinkedIn. I will share his LinkedIn. Yesterday, he got the best startup award. Swapnil, can you elaborate a little bit on what award he got yesterday? He was awarded the best startup award. Yes.
Hello.
Yes.
Yeah, I'm sorry. My Wi-Fi some problem. So
Not an issue, sir.
I don't know
No issues.
where we were last. So what did you hear last?
So you had been speaking about the Jeff Bezos telling about Alexa.
Yeah.
That she hears
So
the device.
5 days back, yeah. So 5 days back, Jeff Bezos put out an advertisement, which was a spoof. So they were a husband and a wife, which were a celebrity couple. And if Alexa hears you and collects your data, then how would Alexa behave? So he was trying to tell the world, don't worry, Alexa is not listening to you. And we are not collecting data through Alexa. So basically, imagine you make a call to your friend and then you tell him that I'm looking for a lawyer. And then you come on your laptop and the next thing you see is advertisements of lawyers and legal firms. This happens all the time because all of these companies have a partnership with each other in sharing data, and Google AdSense server is linked to all of this data. So what I'm trying to tell you is smartphone is a good way to bring out the solution of your problem. And a lot of these companies which have got funded, they are apps, or they are companies which are having a solution on the smartphone. Then the next is the team behind. Single founder companies, investor don't like very much because they can be a fight anytime. And it happened in one of my clients' case. They got funding. It's an agri-tech company, single founder company, and they got funded from Infraco Asia, which is a multinational kind of fund with government money, with financial institution money. And they had a fight because Infraco had a lot of compliance requirements because they had to send that data to the government. And the founder had a fight that, all the time I'm just meeting your compliances. So So nothing happened of that company because the founder left and nothing happened actually. So so your solution, and then the next is sorry, the team. In the team, please have a balanced team. Have your marketing guy in there, have your product guy, have your uh, founders, and the way to build a team for a startup, your salary paying capacity is limited, and in the earlier rounds the investor won't allow you to pay too much of salaries. Even the founders have to take small salaries, so you can do it by giving some equity to the team people. And in some cases you can give ESOPs also, employee stock option plans, and ESOPs, they vest at the end of 1 year, 2 year, and 3 years. So so these ESOPs, once the person is performing for you, he gets some ESOPs, and then you can give an exit on the ESOPs as and when your funding rounds happen. So this is the role, the team. Then the next is market size. Many people think that market size doesn't matter, but it matters quite a lot. And so basically, if you are operating in a small market, then there is a limit to how much you can go up. And so there was a company which came to me. They were operating in the digital out of home market, which is a in India is a very small market. And they were operating there, and because the market size was small, they faced a lot of issues in raising money. Because see, end of the day, there was another company which came to me, which had created organic products, and these products met the norms of European certification EcoCert, and which is the highest certification for organic nature of the product. Now, a lot of products in India sell by saying they are organic, and 99% of them are not organic. They damage your body, they damage your skin. So the founder, uh, he was consistently asked the question that the Indian consumer does not know what is EcoCert. I mean, you are doing digital marketing through Facebook, sponsored ads, or Twitter, or LinkedIn, and then you are saying we are EcoCert certified organic product, but the consumer does not know EcoCert. So end of the day, the company has to spend money to educate the customer. So in a way, they have to spend money to grow the market. Now that is a very bad situation for the investor, because he has to not only put in money for the company's products and stuff, but he has to put in a lot of marketing money to educate the customer. I don't know if you all guys remember, many years back there used to be advertisements from Federation of India. So the egg consumption in India wasn't increasing for the reasons that we are all vegetarians, many of us. So they had to spend money to grow the market. So market size and opportunity is very. I will cover this in the other slides also. Then the next is business model. How does your product make money? This is more important. Apart from business model, the product as well. Now the beauty of product is that you can show the product pictures and videos to the investor. So directly he sees, okay, this is the app, this is how it works, this is the problem it solves, these are the app installs, and this is these are the number of daily active users, monthly active users. So you can show. But more important than that is the business model, that how will you make money from that particular product or service. So whether it is commission based or monthly, yearly subscription, direct sales, and so on. Many techies, when they understand technology, they start building a product with a lot of passion, and they just stop sleeping and they build the product. But end of the day, they forget that there has to be a viable business model behind it. And end of the day, the consumer nowadays, if you look at whichever product Google puts out, uh, they f- they initially put it out for free. So it is a freemium kind of model. And once a person gets used to it, they start charging. And that also, there is a limit to how much they will charge. So Udan is a company started by IITians, and they said we will create a platform where uh, SMEs, small and medium enterprises, and MSMEs, medium small enterprises, they will interact and do business with each other. And their revenue was hardly 60 crores. But on the funding side, their valuation had crossed $500 million. So a lot of people used to ask them that your business model does not seem to be fine. So they said we will monetize later. We are building a platform, we are building a captive customer base, and we will monetize later. And this is exactly what they did. I mean, from 60 crores, once they started charging, the turnover increased from 60 crores to 1300 crores next year. And this year they have done 5,900 crores. So it clicked with them. With many people, it doesn't click. So share chat, as I told you, share chat was chat engine for vernacular languages in India, and they were a zero revenue company. They got $1 million from Elevation Capital, and uh, now they are $3 to $4 billion company, and the user base is almost 300 million people, 30 crore people, which is a valuable data to have. I mean, data on the vernacular speaking 30 crore Indians is like amazingly valuable. But my point is that it is still zero revenue. They still don't make any revenue, but the valuation of the company is more than, I think, $3 billion. At some point, they will start making revenue because, see, eventually they have access to that data. So that data can be plugged in with a variety of consumer products through Google AdSense or through any of these big technology companies. And day one, they will start getting huge money for that data. So you can monetize later. I mean, that's the point I'm trying to make. But having said that, uh, the investor does see the business model. I mean, you can't be like zero revenue and get away with it all the time. The next is current traction. That's exactly the point I was trying to make. What is your revenue growth? What is your customer growth? What is your vendor partners growth? What is on the ground right now? I mean, that is now a lot of companies which come to me, they say they are pre-revenue, pre-seed, pre-product, pre-service, then they are pre-money also. I mean, not a lot of people won't put in their money. I mean, you have to you can approach angel investors. There are two types of angel investors. One is the rupee angel investor, which puts in 1 lakh to 40 lakh rupees. And then there is the dollar earning Singapore banker or Hong Kong banker or Dubai banker. They put in 2 crore, 3 crore, 4 crores. And then there are industrialists who put in money. Then the startup founders who made it big, they put in money, like Kunal Shah of Cred and Freecharge. They put in money. And Rajan Anandan of Sequoia, he puts in, like, he has put in 200 companies, but small money, like $50,000. But then everybody wants Rajan Anandan on your capital table, right? So, and then there are housewives of industrialists who have turned angel investors. But again, don't think that angel investor is not aware. After Shark Tank, angel investors are very aware. I mean, I have a pharma distributor lady from Ahmedabad. She does not know much, but still she asks all the questions from the companies who I take to her. And she has somehow read this and that, and so everybody is wants to be in that game. Next is competition. Again, if you are not able to place your company in the minds of the investor, then you can give example of the competition, that this is my competition. And this happens many times in my investor calls. Once you give the name of the competition, they are able to understand what you are creating exactly, because you might be creating something totally new to the market, and there might be a precedent of the same product or service in the US or in the UK or Singapore, but maybe not in India. But the investor, because most of the investor money in VC funds comes from abroad, so many times these guys are actually educated from Ivy League colleges, so they understand the foreign products also. And since you are giving the competitor's name, then you also give your competitive advantages, how you are better or different from the competition. And don't praise the investor too much. Try to give the weaknesses of the investor, that these sorry not the investor, the competition. So basically, in a way saying that this competition has this product or service, but they are missing out on these pieces which we have identified and placed in our product. So that is one thing. And then after that comes the financial projections. See, the investor puts in money, the company is in losses for 1 or 2 years. And then the EBITDA starts coming up, the operating profit starts coming up, then the cash flows become positive. So the financial projections we have to give is of, it's good to give for 5 years, that how will your cash flows become positive, and how will you start making money on the business. And then the funding ask, you have to be very clear as to the amount of money you are asking. Many times there is a confusion. Your team person says 10 lakhs and you are saying 4 crores. So it doesn't give a very good impression. And then the use of funds, like how much will go into marketing, how much will go into team, how much will go into technology, and so on. And the last thing is the roadmap. The roadmap for 1 year, 2 year, and 3 years. How many customers will you have? How many distributors you will have? How many offices will you have? How many new markets you would enter in the next 1 year, 2 year, and 3 years. So this is the presentation on what investors are looking for. And there is one more presentation. I don't know, 2 presentations will be too much, but that is basically on what to include in a pitch deck. So there is one way: either I can throw the questions open for this part of the presentation, or if you guys want, then I can do the presentation and then take you there to the next one. So do let me know how to go about it.
So honestly, your call, whatever you're most comfortable with, we're open to that.
Okay.
Deepika, I think the second presentation will be important for our audience here, because they have to pitch to the VCs.
Okay, sure.
We will
Sure.
consider.
So Karan Bajaj is the founder at White Hat Junior, and he came from a corporate background, and then he sold his company to Byju's for $300 million. And he had done some some funding rounds. So recently he has been coming up with a lot of videos and a lot of social media posts explaining how he went about things. So I made a presentation on whatever he told. So I'm I want to tell you that this is all Karan Bajaj's words. These are not my words, but I really liked it, so I'm showing it to you. Yeah. Are you able to see this?
Yeah, yes. Sure.
Okay. So what is a pitch deck? It is a brief presentation, good design, pleasing slides, updated information, accurate market and competitor analysis, viable growth metrics, and a vision. Why is it important? You understand why is it important, right? I mean, it is to give investors a reason to believe that the startup is viable. Now, there are three pillars of a killer pitch deck. One is company's vision and results, then is market opportunity, and then is funding ask. So basically, the investor is looking for what is there on the ground right now. Second, what is out there in the market which the company can achieve. And three, how much funds would the company need to achieve that. And so we separate our pitch deck into three main parts. First is company's vision and results, which means company results, company vision, growth plan, strategy, consumer passion. Second is market opportunity, market size, tech disruption, competitive differentiation, and then the funding ask. And unit economics is very important. After WeWork wanted to come out with a $45 billion IPO and the valuation on the stock exchange, the investment bankers told him $8 billion. So from 45 billion to 8 billion. And SoftBank then scuttled the IPO because the unit economics of WeWorks were so bad. It was taking the best real estate location in the cities, very costly lease rentals, signing up leases for 15 years, building 7-star infrastructure, and the end consumer was the gig economy guy who was in and out of jobs, whose paying capacity was limited. So because of this lopsided business model, the company was in perpetual losses, and that's why the unit economics of the company was bad, and that's why it could not come out with an IPO. So funding ask is unit economics, 3-year growth strategy, application of funds, and management team. So it's basically whatever we have already discussed, right? I mean, but we are presenting it in a very smart way. I mean, this is what I liked about Karan Bajaj's approach. Slide 0. Now you must remember, you have to be a great storyteller. Great storyteller. If you want to raise funds, you have to tell your story. You have to tell why did you stumble on the problem statement? How are you passionate about it? And end of the day, there is nothing on ground much in a startup. So everything is 5-year projections, right? I mean, this will happen, that will happen. So why this will happen, why that will happen, how are things moved, how are the dynamics of the market moved in the last many years? What precedents do you see from global markets? How will they happen in China? Then how will they happen in India? All these stories, I mean, you have to be a great storyteller. So your personal story is very important. Believe you me, I've seen a doctor couple who were unable to conceive. They finally conceived after so much of difficulty, and they have a fertility chain of clinics. I mean, because they wanted to give others, the same knowledge which they ultimately, and the facilities. And this guy whose father was in border security force, he saw how soldiers are dying on the border because they don't have proper technology. So he spent 6 months on the Kashmir border, Indo-Pakistan border. So he saw for himself. And then he came and set up a defense technology company and got funded within no time, because he had such a powerful story to tell. So your personal story, then the business growth and results. If you're already doing 50% growth, then the slide 1 has to say, okay guys, we are doing 50% growth. Now let us talk more. So it adds a big punch. It shows your potential. So always start with that when you are presenting your pitch deck. It will spark the attention of the investor. So the growth rate and actual performance versus expected performance, 2 aspects. Then is the company vision. What do you plan to do with your company? And if you have a strong business plus a compelling vision, you already have a strong business plus you have a great vision, then the investor is already 50% there. So uh, uh, White Hat Junior's vision, as given here, enabling a generation to create versus consume. So the generation is totally into smartphone. They are spending on gaming, a lot of time on gaming. So they're consumers of data, right? So enable them to start creating, whether it is on coding or it is on music or it is on any such creative activity. The next is business strategy. That how will you meet the vision, and the three best strategies that will help you achieve the vision. So we have some examples from White Hat Junior. So Wow Kid Delight curriculum. I mean, amazing curriculum for the kids. Top 1% teacher. So you have to take the best teachers, and tangible parent outcomes. So uh, you know outcomes for the parent which you can measure. That is why tangible parent outcomes. Now slide 4 is customer satisfaction. Customer satisfaction, again, it is using different metrics like CSAT, like total number of satisfied customers to total number of responses into 100. So these are some of the metrics which are used for edtech companies. You can see here. Then slide 5 is the market. Now the three formulas which we use for measuring the market is TAM, SAM, and SOM: total addressable market, serviceable obtainable market, and serviceable available market. Now slide 6 is why now is the best time. Like we have already said, our company is already doing it. We have the vision, we have the strategy, we have the market. Why now? So again, all the market information captured beautifully in a single slide, telling that now is an inflection point for you, for the company to grow even stronger. And to justify that, uh, there are figures like appeal across Indian metro and non-metro, appeal across age groups, appeal across income segments, appeal across geographies. So in 4 beautiful graphs, he has captured why now is the best time. Now, your technology disruption, always remember, technology makes it very scalable. And technology gives a moat. Investors call it the moat. The moat is the body of water around the forts, which do not allow the invaders to come in the fort. So, what is your moat, which will protect you against fresh competition? Because your competitors have deep pockets, they can put in money anytime to beat you. So what is your moat? So your technology, a robust technology layer is a great moat for rapidly scaling operation. And so the moats which he has given is India's largest tech-enabled live operation, world-class growth, hacking, and tech-driven enhanced student and teacher experience. Then, of course, competitive differentiation. On a chart, he has put in the competitors' names and his own brand to say that where he stands with as compared to the competition. And here you can list down your unique selling proposition, USP. And if you are in a blue ocean market means there is no end to the market. And how your product is 10x better than the competitors. Unit economics, I already told you, you should be earning money on each dollar of investor money spent by the company. You should be earning money. That is unit economics. You should be profitable in your growth. So He has given unit economics focus, obsessive unit economics focus, that overall business per student economics, and most capital efficient model in edtech. So the return on capital is the best. So he has given it by certain charts. Then the growth plan, annualize gross bookings by scaling the model. Then the funding ask, how much funds you're asking for and how will you use the funds. 13% capex, 11% product development, 33% marketing and sales, 43% personnel. Then the team, as I told you, a well balanced team. If there are people from the Ivy League, like IIMs, like you guys, it helps a lot because the fund guys are themselves from Ivy League. So it really matters quite a lot. And then key takeaways. So the core purpose, takeaways of the entire pitch deck thing, that the core purpose is to create a compelling story. Stick to the principle of one idea per slide. One idea, that's it. Because as I told you, the investor has a short attention span. And last, consider how you will present your pitch deck in person. So the same pitch deck, if you were presenting in person, how will you verbally supplement it? This is it. I wanted to run you through this presentation because I really liked what Karan Bajaj presented and the way he presented. And I thought that it was a very smart way of uh, leaving nothing for the investor to say. The investor doesn't have anything to say because on each point you have given him data, you have given him insights, and then he says, what do I say? I mean, the traction is there, the company is there, the vision is there, the market is there, the strategy is there, the funding ask is there, everything is there. So this is my presentation, and I'm open to any questions. And thank you all, Deepika. Thank you all. IIM Bodh Gaya.
Thank you so much, sir. Indeed, a very, very informative session, especially taking into consideration the combination that you've mentioned of data and insight, and combining that with the personal story that you're presenting. I think that's really very important. And with that, I think I'll just directly open the floor to a Q&A round with the audience, and I would request everyone to either directly post their questions in the chat box, or they can raise their hand and ask the questions to sir. I see Laksha has already raised his hand.
Am I audible?
Yes, you are.
Okay. Good morning, sir. So my question is that when my startup is just in the idea stage, that I've not made the MVP, I'm just in the idea stage. So how should I tell the investor that this will be my projection in upcoming 5 years? That they can have a very good cost question that you have not even made the product. So how are you telling that what will happen 5 years later? How should I convince them on that part?
So see, if you are in idea stage, then someone who knows you and knows your potential will likely bet on you. So your relationship with the investor will get you the money more than your anything else. And that is why just hold on.
In the meanwhile, while Sir returns, anyone, if you have any questions, you can just post them on the chat box and we'll take them on. Right, Tejas, you have a question?
Yeah, I have a question. I have 3 questions.
Yeah, so at idea stage, at idea stage, we recommend that you go to an accelerator or an incubator. So what do accelerators and incubators do is that they take your equity between 3 to 8% equity, and they give you between 15 lakhs to 50 lakhs. And they give you, people come from industry to give talks. So if you have a certain kind of person from the industry who you feel would actually be able to guide you as to how to create this product. You can make him a mentor by giving him some equity. And they have co-working space in many cases for 1 year. They will give you co-working for 1 year free, along with that 3 to 8% equity. And they will give you Wi-Fi, and they have tie-ups with CS, CA, lawyers. So they give you cheap service providers. And but investor will put in money only if he knows you personally. Like, I'll give you 2 examples. There was this Bangalore-based company, and Weddings.in, which is an aggregator of banquet halls. They did a turnover of 12 crores and got sold for 400 crores. So these guys started the same type of company in Bangalore, and they were from corporate, so they didn't have much money to invest. So one of their corporate friends, he said that, okay, let me give you some money, you start. So they valued the company at 1 crore, and that guy put in 36 lakhs and took 36% equity. And similarly, one person based out of Delhi who was from real estate, he saw Weddings.in, and he also wanted to start a similar type of company. So before starting, he went to a big builder. So builder knew him, that he's a property dealer. He said, I will start Weddings.in type of company. And the builder said, okay, let your value be 10 crores and let me give you 3 crores for 30%. So in both cases, it was the relationship. But the point is that they were in the same industry, but one got a valuation of 1 crore, the other got a valuation of 10 crores. Because there was nothing on the ground. So how do you calculate the valuation? It is all based on perception. So if you're an idea stage, it is the relationship. You have to, I will tell you guys how to approach investors. Build your Google presence. If I search Lakshya Agarwal on Google, does it show me the work done by Lakshya Agarwal? Does it show me the blogs written by Lakshya? Does it show me the webinars conducted by Lakshya? Does it show me what he's doing in life? What is his work? And if you are passionate about the startup which you are building, you write a lot, you speak about it, you talk to people, you go to events, you exchange visiting cards, you do a lot of networking, you hustle it out. And that will get you the relationship, that will get you the money, that will get you your angel investor. Thank you.
Thank you, sir.
Thank you, Lakshya. Tejas, you had a question.
Yes, I have a couple of questions. The first question is regarding deciding the market size. So there is a slide that said decide the market size and opportunity. But this is a very, very hard thing to do if I think of it. So if I think of Uber, for example, Uber, let's say Uber went to a VC for some funding. If we were to say I'm a cab service company, then something similar on similar lines, then his market size would have been completely different from, say, what Uber is doing now, which is Uber Eats and everything. So it's kind of I find it very hard to decide what the market is. I'll take another example also. Organic foods. You mentioned organic foods. What will be the market size for organic foods? 6 billion people, because everybody on earth would love to consume organic food. So how do you decide what your market size actually is?
So very good question. So basically, we do it by top-down method or bottom-up method. The top-down method is GDP of US is this much. The size of the total revenue generated by organic food sector in the US is this much. So this is the percentage of GDP, which the US is. And as in all cases, US is the most capitalist market. So that number is likely to be the highest. Then China started 15-20 years back. It was at this much percentage, and right now it is at this much percentage. India is at this much percentage. So basis the 15-year back situation in China, India is likely to grow this much. So that is the top-down method. The second method is you find out the top 5 companies in that particular sector, go to the Ministry of Corporate Affairs website, pay 100 rupees and get their audited annual statements. So you will get the revenue of top 5 companies in the sector. You add up the revenue, then you find out from the public domain what is the percentage market held by these companies in the country. So maybe you get a 30% number or a 50% number, or maybe you have to assume. And basis that assumption, you calculate the market size. But as you rightly said, for aggregator companies like Airbnb and Uber and everything, the market size is actually, it's a blue ocean market. I mean, a lot of companies come to me from the electric vehicle side, and it's an unlimited market. I mean, there's so many two-wheelers which sell in India, and there are already so many two-wheelers on the ground. If potentially all of them will be converted into electric, then it is an unending market. So you are right. This company had come to me, eBike Go, 4 years back, and they said that we will give electric vehicles to drivers of Zomato, Swiggy, Flipkart, Big Basket, and so on. And he didn't have to tell about the market to any investor. It's an open, one can easily know what is the market. So in the market slide, he had put in a photograph of a bike going towards infinity. That's it. So you are right. Thank you, Tejas.
Thank you so much, Tejas. I assume you had more questions. Okay, right. We have Muskan over here. Muskan. I'm so sorry, but you're not audible.
Yeah, it's not.
There seems to be some disturbance. Muskan, you can just. Okay, she's left the
There
meeting.
are a couple of questions in the chat. Yash Singhal has asked, how do
Sure.
Right, we can take them.
Just a minute, I'll just take it. You guys can add me on LinkedIn. This is my LinkedIn profile. Which question should I start from the top?
How do venture capitalists verify or evaluate future profitability of startups before investing in them? And what is the success rate?
Okay, future profitability of startups. So when you are achieving the product market fit, you do a secondary and primary research. Secondary research you do by putting out Google Forms and polls on social media sites. So if you look at LinkedIn, nowadays there is a trend of putting up polls. So you see people, which is the best dress Steve Jobs should have worn? Red, green, white. And one starts giving in answers to all kinds of questions, whether it matters to you or not. So that is one, that is secondary. And the primary way is that in whichever market your product is likely to sell, you send some office boys with a form, and they will get the form filled. So you will get to know about the customer preferences and the price points at which the customer wants to buy it. But of course, when you start selling your product, that's when you realize that what is the price point at which this will sell the most. And basis your cost structure, you will be able to make out the profitability. So that is why, as I told you, they like to put in money after the PMF, because at that time, all the loopholes have been closed. But before PMF, all these questions are there, whether it will be profitable or it won't be profitable, and so on and so forth.
Right. Thank you so much, sir. Do we have more questions? Yeah, Tejas.
Yeah, it's quite linked to the first the question that you just answered, which is you've now found the ideal TMF. Now you've also found the guy is also ideal. He has been generating some revenue, although there will be cash burn in the first couple of years. So when do you ideally expect a startup to start giving you dividends? How long and before it becomes I don't know how long. So let's say there might be a stage where the money that he's reinvesting in the business is just getting the money that he's reinvesting is not necessarily generating completely into profitability, but also just running through cash burns instead of actual generation of cash. So what time do you say, no, stop pre-investing and start giving me dividends?
See, investors know something which you guys don't know, which is the beauty of compounding. So when you list a stock on the stock market, people start chasing those one share. Because they start chasing that one share, the market capitalization of the company is in billions. Same happens in crypto. Somebody launches a new crypto at 7 paisa, it becomes 100 paisa because the power of compounding. And suddenly the valuation of the total number of coins in the market becomes $100 million. So what I'm trying to tell you is, end of the day, if the investor is able to get out from the company and he knows that he can sell the company to another person, sell his shares to another person, टोपी जो खुद पहनी थी वो दूसरे को पहना पाएगा या नहीं? So, if he's able to put the topi in somebody else's head, he's fine to put in money in your company. And by this, I mean to say, Zomato is burning investors' money. Since many years, it is just growing the market and it is in perpetual losses. And the more it tries to expand, the more losses it makes, which means the business model, unit economics is quite bad. So they are charging 25% of the order value. 600 rupees dish, 150 goes to Zomato. But still it is in perpetual losses. But they were able to list on the stock market at a good valuation. And all the investors who were in there, they got an exit on the stock market. So let's put it differently. Look at Amazon. Amazon, since 1994, it made losses till 2014, 20 years. And all this time, its stock went up. The valuation of the company went up. The investors were not receiving any dividend. The investors were not seeing any return on capital employed, return on equity. But they still kept on funding the company. Why? Why did they keep on funding the company in spite of the fact that the company was making losses? Because the company was putting in money into new business. It created Amazon Web Server. It created Amazon Prime. It created huge number of businesses. So the investor thought, even if it is making losses, but every time its market share in a whole number of industries keeps on going up. So they wanted the slice of that bigger and bigger and bigger company rather than thinking about the losses. And being in losses was a smart strategy. You don't have to pay any tax because you are utilizing that money to grow your markets in other businesses. So that strategy, it does not have a downside to it.
Definitely, sir. A clever move on their end. Muskan, you had a question.
Okay, am I clear? Audible now?
Yeah.
Yeah, sure.
Okay. So my question was like, what is the investor mindset or perspective towards the co-founder of startups, like who may not be of the top colleges like IITs or IIMs? So what their perspective or mindset towards that?
So Ivy League people, they get a better preference because all these fund guys are from Ivy League colleges, so they prefer their alumni. And as I told you, this funding, initial fundings happen because of relationships. So if you are alumni relationship, then naturally you have a place on the door to put your hand in. And but having said that, what example to give you? I mean, E-Bike Go, when he came to me, he told me he's a chiropractor from Mount Abu. He used to, help people remove their back pain by using oil. And now he has a successful electric vehicle company, well funded. So there is no limit to which person can achieve what. And don't forget the theme, another theme which is playing out in the Western markets and now increasingly in India is ESG, environmental, social, and corporate governance. So companies which are ranking high on environmental, social, and corporate governance, they get huge amount of funding. So there are all kinds of people who want to do something on the ESG side for environment, for upliftment of social strata, using corporate business models. Total value of uh, uh, ESG funds uh, controlled by investors in the US alone is $913 billion. So you can imagine the amount of money which is out there if you are not from a Ivy League college and still you are doing something smartly and you are doing maybe something on ESG or any other good problem statement which you are solving, then surely, I mean, one way or the other, you will get the money.
Right, sir.
Thank you.
Piyush, you had a question.
Yes. Hello, sir. I just have three small questions. The first is related to the, we have seen in Shark Tank that they mentioned that there is a very important significance of the name which you give to the startup, but it should be in synergy with what you are doing. So, what according to you means how should we go about while we name the startup? Second thing, even though we are serving the niche market, so what do you think while we are planning the vision of the startup? Should we keep it very niche or should we keep a scope that if we grow in the future, we can enter into other markets also? The third thing is about what you mentioned about the niche, about this unit economics. So I am also working on a startup and I know that my business will be profitable only when it reaches economies of scale. And initially I was planning to go with the penetrative pricing. So in that case, what would you suggest that how do I present my unit economics to the investor?
Good questions. So the first part is naming of the startup. There is this partner of mine in the US, GSD Venture Studios, and Gary Fowler is the guy. And so earlier he used to have a software company in Russia, and the name of the company was some Guatsovo or some bullshit. And nothing happened of that company. He opened an office in the US and changed the name of the company to Click Software. He got $50 million funding in 6 months. I mean, end of the day, the investor is seeing that ticker on the screen, na stock market mein. So he's seeing the name. Oh, the analysis is done by somebody else that audited statements and all those stuff. So your name should be smart. I mean, there is this client of mine, India IVF Clinics. So for approaching the investors, we have kept the name Flirtility. Flirt with fertility. So we have done 20 calls, 20 investor calls after we changed the name. So the name is very important. Sometimes people come to me, merakirayedar.com. Man, what will you do with merakirayedar.com? Which are the investors who will put in merakirayedar.com? I mean, you have to be smart about your name. Okay, the second thing, vision, niche, and scope for future. Yeah. So there are two approaches in business. One is I will create a niche, but I will own 80% of the market. The other is I will be in a $5 billion market, but I will capture 2% of it. So it really depends on sector to sector. I don't have a broad commentary on that. But if you look at the companies who were in a niche, slowly they faced investor pressure and they started offering a broader line of products. and because the numbers have to be there to justify your valuation, and many times the valuation is not only on the basis of financial numbers, revenue, uh, operating profitability. For technology companies, there is a smart keyboard company which is my client, and they are doing a Series D, 250 crores, and the valuation of the company is on the basis of pure metrics, that your competitor has this many monthly active users and daily active users. I have this many, so his valuation is this much, my valuation should be this much. No revenue stuff, no money making stuff. So it really depends from sector to sector. I don't have a broad answer to this. The third is unit economics. See, the investor is fine with losses, yeah, because in the initial years you will put in money, you will have to invest, and whatever money you will be earning, you will be reinvesting also. So the first 2 years, you will start building your returns, your cash flows will start coming in, and then in the third year, it will turn positive. The positive cash flows will come. Uh, but the thing is, you should not run out of cash without any option. That is the worst situation possible. Because if a company which is set runs out of cash, at that time, if he goes to the investors in the market to bail them out, they will get 25 paisa to a dollar, which means 100 crore की कंपनी को 25 करोड़ की वैल्यूएशन मिलेगी. They will get 25 crore valuation on 100 crore valuation, because everybody will benefit from your misery. So if your cash planning is not good, you will end up in a soup. Your investors will also end up in a soup. So a lot of these funds which invest and put in money, they keep money for follow-on funding rounds also. And in most cases, sorry, not in most cases, in many cases, they lead the future rounds also. And if you are leading the round, it becomes easier for the other investors to put in your money, because somebody is leading the round and showing faith in the company. So plan your cash flows wisely. That is the only thing. Strategy, as I told you, Udan was making losses, 60 crore turnover, 2000 crore losses. Now, then it increased to 1300 crores, and this year 5900 crores. So any strategy can succeed if you know what you are doing, but plan your cash flows better.
Thank you, sir.
Thank you.
Thank you, sir. We have another question in the chat box. I'll just read it out. How is the valuation of stock done for loss-making companies in the market?
As I told you, टोपी पहनाना आना चाहिए दूसरे को. So basically, if you are able to find the investment bankers in the market to pick your stock in the market making during the pre-IPO stage. So basically, okay, there is a history to it. Okay, the history is that markets are becoming very competitive, and there are so many companies always coming up. So even if you have a good price, somebody will come up with investor money and burn the investor cash and lower the price and try to spoil your market. So the thing is that you also have to lower your price. So then you also come in losses. Now, if you are also coming in losses and the other companies are also coming in losses, then end of the day, the cash has to come from somewhere. Either it has to come from profit and loss side or from the balance sheet side. So what is happening in the world is that the central bankers of the world, the Federal Reserve and the Reserve Bank of India and the Chinese central bank and the European Central Bank, they are printing huge amount of money just to fund the economy and just so that the GDP does not become negative, the GDP growth. And the negative GDP growth is called a recession, technically. But recession word is such a big thing in the minds of Western economies that GDP negative नहीं होना चाहिए. उसके लिए हमें $25 trillion we have printed since COVID. $25 trillion just to shower on the stock market, shower on venture capital, shower on hedge funds, shower on real estate. But GDP should not be negative. So that is the prescription of things we are living in today's times. And till the time is the party is continuing, investors are not bothering about losses. You saw the Zomato IPO, you saw the Paytm IPO, and don't be afraid of losses. But okay, how is the valuation of a stock done? The valuation is done by future cash flows, discounted cash flows. So basically, you make projections for 5 years that this will the money which will be put in, and this will be the revenue generated. This will be the operating profit, and so the free cash flows available to the business in the next 5 years will be this. And then you bring the value of these free cash flows from this 5 years in the future to current value, uh, basis the cost of capital in that particular country and in that particular stock market. And that value is called discounted cash flow. So all these loss making companies, they are not based on market multiples, they are not based on transaction multiples, they are not based on net asset value, they are not based on PECV, profit earning capacity value. They are based on discounted cash flow. I hope I answered your question.
Yes, sir. We have time for just one more question. Tejas, you can take on the floor.
The DCF analysis. Now, DCF analysis for loss-making companies, won't it just, because obviously when the net income, or he said it's a loss-making company, so net income will obviously be negative. So unless you have like a depreciation that is so huge, there is no possibility of a free cash flow itself, right? For a positive free cash flow. What's the point in doing a discounted cash flow analysis when the cash flow itself is not positive? Anyways, it's just going to burn through cash. So you're not going to get any dividends by investing in that. That was the question that I had after you said DCF analysis.
Good question, Tejas. Suppose in my projections, I put my growth in revenue as 100%, 200%, 500%, 1000%, and 1500%. And my increase in cost as 10%, 20%, 25%, 30%, and 35%. Then what will be the free cash flow available to me in the next 5 years? It will be hugely positive. So I bring the value of those free cash flows and the terminal value for today's value and make the projection. And so sometimes it becomes the reverse exercise. मुझे मार्केट में इन्वेस्टमेंट बैंकर से 2000 रुपए का भाव मिल रहा है शेयर का, उसके लिए मुझे डीसीएफ सबमिट करनी है सेबी को, तो कर दो. End of the day, you are getting a buyer, so that matters more than the technical stuff, na? So that's what happens.
Yeah, agreed, sir. Well, then, thank you so much, sir. It has really been a pleasure to host you today, and thank you so much for the session and for the Q&A round as well. And with this, we come to an end for today's first session, and we would soon be resuming the workshop and moving on to our last session for the series at 2:30 p.m. And we really hope to see everyone over there.
Thank you so much. I will still request everyone of you to add me on LinkedIn because I would like to stay in touch. And thank you so much for this amazing session. Very intelligent questions and very receptive audience. And thank you, Deepika. Thank you, Tejas. And thank you, everyone else. Have a good day. And I would need the recording, Deepika. So if you could.
Yes, sir, definitely. We'll make sure.
Thanks a lot. Have a good day. Take care. Bye, guys.
Thank you. Thank you very much.
Thank you so much, sir.
Bye.
Thank you.
think we can stop the recording now.